Well, the markets are off to a good start to the week with stocks up following news that President Trump will extend trade deal deadline with China past that March 1st date that we had all been looking at. Joining us now to discuss is Jim Awad, Senior Managing Director at Clearstead Advisors. Jim, thanks for joining us.
Pleasure.
We're getting a little bit more clarity on the China situation, the trade situation. I guess just as far as you see it for the rest of this year, how important is clarity on where the U.S. and China stand on trade going to be for the market?
Yeah, well, we wouldn't have gotten here without a developing clarity on China. And, you know, Trump's running for re-election, and the Chinese need a deal, we need a deal. And the markets wanted a deal. I suspect the deal will be less than the hawks wanted, but better than what we have. And people can get back to business and do their capital spending and supply chains. And it's good for the economy, and it also takes the pressure off the Chinese. So were it to fall apart at the last minute, I think it would be terrible for the markets. But I think that would be an accident. I think all sides want it, and it's likely to be a great photo op in Mar-a-Lago, and it'll be a perceived big win for Trump in his election campaign. And so part of the reason the markets are up is you do have that clarity. Now, for the markets to do much better from here, I'll tell you what you need. You need the Fed to stay out of the way, the China deal to be done. I don't think Korea is important in terms of the markets, but you need to get through first quarter earnings reports, where expectations are very low, and have analysts start to raise expectations based on a beat for first quarter earnings reports, because you're only talking 3, 4, 5% earnings gains this year is the consensus, and the market's up 10, 11, admittedly from a low base. But to do well from here, you need to have higher conviction and a reacceleration of the economy in the second, third, and fourth quarter and earnings, the Fed to stay on the sidelines, and for Washington to be quiet.
Wow, that's like too many things now.
Yeah,
now I'm thinking this is like we need too many good things to keep happening to keep
for the market to make new highs is what I'm saying.
Yeah, I mean that to me actually sounds kind of pessimistic.
Well, no, I think you know, the markets have gotten here for the right reason. They're about where they should be based on valuation. They got undervalued. Expectations got too bearish, and you have clarity on the Fed and clarity on China, which you didn't have in December. So actually, in retrospect, the market has been very reasonable. But for investors to expect another 10% in stock prices,
that's irrational.
You need to have an uptick in earnings estimates from here.
Yeah, I agree with that almost wholeheartedly. And I think that, you know, Myles and I were talking about what's going to happen when this agreement's signed. And I think I said the market would go up a little bit. I'm going to back off that because I think that's really starting to get priced in.
I take the cliche, sell the news, of course.
Well, I think we're starting to see that the market going up, you know, day by day. Well, because they keep dripping out the good news. We're getting closer and closer, and the market goes up, you know, another 100 points, another 100 points. So when we get there, I don't think there's going to be a whole lot of bang for the buck with the announcement. We'll have already priced that in because the market's anticipated, because they keep talking about it so much.
Right, and if it were coupled with some bad news from Washington on the bickering between the various branches of government, and if that started to crowd consumer and investor psychology, that would be the negative scenario. And then you limp into first quarter earnings.
But then we have the Jan Rogers problem. And I don't know if you know what that is, Jim. The Jan Rogers problem is once we solve the trade dispute with China, how good is the Chinese economy? That's what, to put words in Jen Rogers' mouth, right?
You take them right out. Now, I think that, and that also goes to the sell the news, because then it's going to be a whole other problem that we're going to be looking
global demand.
at. We know what's happening, and it's not great over there to begin with.
No, it's not great over there, but solving the trade dispute eliminates some of the pressure on China, allows them to focus more on revitalizing the economy. And of course, you have Europe, which is slowing also. So I am in no way making a big bull case for stocks from here. I'm saying it's possible you can get another 3, 4, 5% if those conditions are met that I discussed. But I think, you know, you have to say it's been a good year. We've earned a year in the first quarter.
Not a lot of catalysts going forward. I mean, that's what I was saying, that after we get through this good news, and it's Q1, and we're sort of pulled up to 10.
It's better than average year already. Jim, I just want to ask quickly kind of about the view that Warren Buffett had on the market over the weekend, talking about the inability to get any big acquisition that he would like at a reasonable valuation. I mean, he has seen things as expensive for the last couple of years. Of course, the S&P's gone up about 50% over that period. And just as you see it, you know, that combination of a lot of PE firms out there wanting to do big deals, they can still finance at reasonable rates. What's your kind of take on that environment in terms of companies doing M&A at sensible prices?
Right. I think for he has the right attitude to stay disciplined. And the risk is the private equity firms who are paying a lot, levering up a lot, at the end of an economic cycle, when it's not probable that interest rates are going to go up, but it's possible that they could go up from these levels a little bit. So if the economy stalls and the private equity firms have over-leveraged, you know, the long-term negative cases have been a lot of debt put on in the last 10 years, and you're closer to the end than the beginning of the economic cycle, but you don't see the dark hole yet. You know it's out there.
Yeah.
I mean, these things always do end, but the debt and the end of the economic cycle, you know, we were talking about this year. If you want to talk about what could go wrong over the next 2 or 3 years, that's it, end of the cycle and debt.
Yeah, certainly helps that the Fed chair is a former private equity man himself. Jim, Awad of Clearstead Advisors, thanks for joining us.
My pleasure.